Top 4 mistakes that self-directed IRA investors make. Now, I'm not just going to go through mistakes that self-directed IRA investors make, but mistakes that individuals make that prevent them from utilizing a self-directed IRA to create a fully optimized, tax-efficient situation. All right, let's get started. Hi, everybody. I'm John Bowens, Director of Education and Investor Success here in the Equity Trust Virtual Classroom. Make sure to hit the subscribe button and the bell icon. That way we can alert you to all of our upcoming educational videos. All right, let's jump into mistake number 1, and that is that a self-directed IRA is some sort of different type of account or structure that's going to create some sort of adverse tax consequences or penalties when you move money from your existing retirement account into the self-directed IRA. It's really important to understand that as long as you're following the rules and the guidelines, when you roll over a 401k from a previous employer or a 403b or a 457 or a thrift savings plan, when you roll over your money into a self-directed IRA to begin investing, there are no taxes or penalties. You're simply rolling the money over directly into a self-directed IRA. If you have an existing IRA, Roth IRA, traditional IRA, SEP IRA, simple IRA, you have an IRA, you can transfer that into a self-directed IRA. Just remember that an IRA is an IRA. Self-directed is an industry term. It is used to identify that you have the ability with that IRA to make your own financial decisions. Now, keep in mind that some financial institutions will offer a self-directed IRA that will only allow you to invest in public market investments. So you can self-direct, but you can only self-direct into mutual funds, exchange-traded funds, bond funds, maybe certificates of deposits, money markets, traditional financial products. But if you're someone that says, I want to invest in private market investments, alternative investments, I want to invest in rental properties, fix and flip transactions, I want to do real estate options. I want to invest in real estate syndications. I want to invest in real estate partnerships. I want to partner up with other investors in an LLC and buy a commercial building. I want to invest in cryptocurrency. I want to invest in physical gold and silver. I want to invest in startups, hedge funds, venture capital funds. If you want to do those types of investments, in most instances, what you need to do is move money over into a self-directed IRA here at Equity Trust, or as we call it, a universal IRA. See, with a universal IRA, you have the ability to not only invest in the public markets, but you also have the ability to invest in the private markets, all of those unique alternative investments that I just mentioned. So the beauty of it is you get to be in control of how you diversify your retirement portfolio. Okay, now let's move on to mistake number 2, and that is you can only roll over or transfer your money from one retirement account into a universal IRA once a year. So you're going to hear about this once a year rollover rule. In fact, if you go directly to the IRS website, which I would encourage you to do, go to irs.gov, they're going to reference the once a year rollover. Now, here's the challenge. A lot of Americans are led to believe that they can only move money once a year because they read the first section but they don't read below. You need to continue to read below, and what you're going to see is there are exceptions to the once a year rollover. Those exceptions include a direct rollover from a 401k or 403b or other plan, or a direct transfer, so transferring money from an existing IRA directly into your self-directed IRA. So what is the process? The process is you never want to take active receipt of your cash and then return it to an IRA within 60 days. You want the money to go directly from one financial institution into your Equity Trust Universal IRA. The once a year rollover rule, they are talking about what's called a 60-day distribution rollover. What that means is if you distribute money from an IRA or a retirement plan, you take active receipt, the money goes into your bank account. As long as you return the money to a qualified retirement account within 60 days, there's no taxes or penalties. Now, most people don't conduct business this way. Most people are going to do a direct rollover or a direct transfer, and you can do that as many times as you want throughout the year. In fact, I see a lot of clients do that here at Equity Trust because they have one investment that they want to make, so they move some money over, and then maybe a few months later, they want to make another investment. They want to buy another property or invest in another real estate syndication or a private money loan or whatever it is that they're doing, maybe cryptocurrency or physical gold and silver. So then they just do a subsequent transfer or rollover. Again, you can do that as many times throughout the year, as long as you're not distributing the money to then return it to an IRA. Okay, that wraps up Mistake number 2, let's move on to mistake number 3. Mistake number 3 is that you absolutely need an LLC to acquire private market investments. I have seen so many self-directed, IRA-oriented administrators and facilitators and other custodians out there that actually force their clients down the path of forming an LLC. Well, that can be very dangerous if in the wrong hands, and individuals could make mistakes. So it's important to understand that you don't absolutely need an LLC. Your IRA could buy a property directly using the IRA, taking title in the name of the IRA. The IRA can invest in a private money loan directly. The IRA can invest in cryptocurrency or physical gold and silver. Now, there are certain applications where maybe you as an investor, because remember, you're in full control. Equity trust is not selling investments, offering opportunities. We're not giving tax, legal, or financial advice. So the idea here is you get to take control and you get to decide how you want to structure these transactions. So maybe you're a real estate attorney, or maybe you have experience in real estate and you want to buy a property and you want to use an LLC. That's okay. What you're going to learn is you can establish what we refer to as a real estate checkbook IRA LLC. Now, that's not an account type, that's a structure, okay? So your IRA is established, and then your IRA would be the owner of an LLC, and then that LLC would acquire a property. So the idea is you look at the opportunity, whether it's real estate, cryptocurrency, physical gold and silver, private money lending, a real estate syndication, a startup, a venture capital fund, whatever the investment is, you look at that transaction and then you determine what is going to be the best avenue in terms of how you structure that transaction. So just know that you don't have to use an LLC, but if there are circumstances that warrant it, you have the ability to do that with the Equity Trust Universal IRA. All right, that takes us to mistake number 4, which is that you can live in a property that your IRA owns. Or as an extension to that, I also hear commonly, I can buy a property with my IRA and then eventually live in it when I retire. Now, you will find there can be some possibilities that you eventually live in a property that your IRA owns, but it would require distribution. You'd want to talk to your CPA about that. In some cases, it's not a financially wise decision. You have to analyze whether that is or is not. But in terms of your IRA buying a property and you staying there in that property, whether you're living there temporarily or long-term, that would be what's called a prohibited transaction. See, there are prohibited transactions that are defined within Internal Revenue Code 4975. Internal Revenue Code 4975 defines disqualified persons to your IRA. The best way to think about disqualified persons are certain family members and certain entities that you're affiliated with. So people up and down the family tree, we oftentimes refer to this as parents, grandparents, children, grandchildren, your spouse, yourself. You're a disqualified person to your IRA. Your businesses that you own, control 50% or greater of, along with other disqualified persons, is also a disqualified person. We have a separate educational video all on the rules and guidelines here. So what's important to understand is there are disqualified persons to your IRA. And if you transact between your IRA and a disqualified person, it's a prohibited transaction. So if you go to 4975C1D of the Internal Revenue Code, you're going to see very clearly the transfer to or use by or for the benefit of a disqualified person of the income or assets of the plan. I like to refer to this as the personal benefit rule. If your IRA buys a property, let's say it's a vacation rental, and you stay there even just one day, the argument could be made that you received a personal benefit and therefore a prohibited transaction. The spirit of the self-directed IRA, the spirit of the universal IRA, the spirit of using your retirement account, which has highly tax advantage privileges. Remember that, compounding interest in the absence of taxation. And you have to understand that there are these rules. You have these powerful advantages and you have to follow these rules. The money that's used in your IRA account to invest must be for investment purposes. That's the best way to think about it. Do it for investment purposes, not for you to personally benefit. All right, that wraps up our 4 top self-directed IRA mistakes. I hope you got a lot of value out of this. Make sure in the description box, you'll see where you can download a free guide all on what we're talking about, self-directed IRAs, the step-by-step process, and how things work. Until the next one, keep leveraging compounding interest in the absence of taxation.